This is FRM Part 1, Book 1, Foundations of Risk Management, and this is Chapter 13, Principles for Effective Risk Data Aggregation and Risk Reporting. Now, there are some elements of the previous 12 chapters that will be contained inside of this Chapter 13, but a lot of it is some new material. It's entirely descriptive, so we won't need any calculations. Let's go ahead and look at the learning objectives. Explain potential benefits of having effective risk data aggregation. Describe key governance principles, data architecture and IT infrastructure. Describe characteristics of strong risk data aggregation, and then describe effective risk reporting practices. Let's start with the benefits of effective risk data aggregation and reporting. The Basel Committee defines risk data aggregation as, and by the way, let me give you some background information on this Basel Committee. Remember, this comes out of the Bank for International Settlements. It's located in Switzerland. That's why it's called Basel. And this organization has been around since after the 1929 stock market crash. I think going back to 1930, actually. And its kind of mission was centered around stability between and among financial markets and between and among financial institutions. Now, this committee released its Accord 1 back in 1998, and then the Accord 2 was 2004. And those two really didn't prepare the financial institutions for the crash of 2007 to 2009, which we talked about in some previous chapters. And so the Accord 3 was published in 2009, and the goal remains the same: financial stability. Although there are three pillars here. There's Pillar 1, which gets most of the attention in the financial press: minimum capital requirements for financial institutions. The second pillar is supervisory review, and then the third pillar is some kind of statement on market discipline. All right, so that's kind of the overarching thought behind this effective risk data aggregation. So let's go ahead and let me read this to you here. It defines risk data aggregation as defining, gathering, and processing risk data according to the bank's risk reporting requirements to enable the bank to measure its performance against its risk tolerance and appetite. So there's a lot that goes into that quote, but let me just remind you, at the last part of that definition, there's a performance and then there's risk. And so this goes back to what we just talked about in the previous chapters with the capital asset pricing model and the arbitrage pricing theory and others out there as well. This relationship between performance, which is return, and risk, which could be standard deviation or beta. And remember, we love those linear relationships that those founding fathers of finance gave us in those models. And so that kind of applies here as well. So think about what's happening here. We're trying to gather risk data so that we can measure performance against risk. There's that risk-return relationship. Now, of course, data aggregation includes sorting and merging and evaluating and breaking down data sets. I always think, even though it's not limited to an Excel spreadsheet, there are lots and lots of fantastic risk data algorithms, but I just think of a spreadsheet where you've got a bunch of columns and a bunch of rows, and you can sort them and you can merge them, and you can identify specific variables that you want to emphasize, and you can identify other variables that you want to de-emphasize. What are the benefits here? And remember that to promote financial stability must mean that there are periods of instability. And so all of these publications and reports are really a response to how do we handle these financial crises or financial disasters. And so let's read some of these. I mean, look, an increased ability to anticipate problems. You've heard me say this before. The 2007 to 2009 financial crisis was caused by a failure to identify the risks, a failure to quantify the risks, and a failure to measure the risk. So think about this. Effective risk data aggregation and reporting is going to enable financial institutions to anticipate problems. Oh, this is so cool. I mean, think about all of the great scenario and sensitivity analyses that we talked about in some previous chapters. If you go from best case scenarios all the way down to worst case scenarios, then you'll be able to anticipate those problems, to foresee them, and then when they actually occur, to have a plan in place to manage those risks, which is the second checkpoint there. Find routes back to financial health, especially in times of financial stress. Every bank goes through periods of financial stress or financial distress at one point or another. And so this aggregation and reporting is going to enable financial institutions to move more quickly back to financial health. And that, of course, includes improving resolvability, which goes to these GSIBs, these global systemically important banks. And remember, there are domestic important banks and there are regional important banks. But remember, I've used this term contagion in previous chapters, in which failures or stress in one bank then kind of carries over to the rest of the financial system, or at least to similar banks. And then my last checkpoint there, it proves the capability to make objective judgments about things like what can we do to get back to a position of financial health. Now, swinging back again to the crisis of 2007 to 2009, was the inability of banks to, are you ready for this? I have it in bold, identify concentrations of risk across business lines. So let's go back to that one chapter where we talked about the dangers of having a silo here and a silo here and a silo here, and having strategies to manage risk for each of those silos. And what you forget then is that there are correlations between and among each of those silos. And so that was really a failure, back in 2005 and 2006, leading up to that financial crisis. And so remember that we don't want to evaluate these as individual silos. We want the umbrella risk management protocol over top of all the silos so that we can identify those individual risks, but then we can see their correlations. And so this committee has pushed for greater governance, and they issued this Pillar 2 guidance, which is a supervisory review over top of things like bank capital models and requirements, and also which kind of tools are used to evaluate. Remember, we have to quantify the risk, and so we can use value at risk, which is a great tool. It's not perfect, but it's a great tool. All right, so key governance principles. There are around 14 of them, which we'll look at over the next portion of the slide deck. So principle 1, governance. So remember, governance is really a system of corporate or organizational leadership and how decisions, both operational and financial decisions, get made and then evaluated after they have been made. All right, so this risk data aggregation capabilities and risk reporting practices should be subject to strong governance arrangements, which means that there have to be principles, there have to be protocols, there have to be procedures for the decision-making process focused on risk management principles. All right, so notice my bullet point there underneath the box. The principle suggests that risk data aggregation should be a central part of risk management. Of course, this aggregation of the data has to provide the foundation so that risk managers can make appropriate and reasonable decisions. Now, what does good governance look like? Full documentation, independent review, unaffected by the bank's group structure. Senior management has a priority and should go to great lengths to make sure that risk data aggregation is part of the entire function. And it also should be a consideration when the financial institution is moving into new areas. I call it new initiatives in the slide. Let's take a quick example. Let's suppose for some reason we're a financial institution and we've completely ignored the commercial lending market. So what does this mean? We're going to, according to Principle 1, a good governance procedure, this is going to be a new initiative, but it's probably going to be similar to some of the other types of loans that we have made, whether they're mortgage loans or automobile loans. But now these loans are probably going to be in greater amounts. So maybe we'll lend 5 or 10 or 20 or $100 million. So what we need to do is make sure that we have a process and a protocol that is established so that when we make these loans to these commercial borrowers, that they are made in accordance with not only the financial institution's vision and mission and principles, but also contained in the principles of risk management that we've talked about over the last 12 or so chapters. Now, here's the important part of this. So let's suppose that we make 100 of these loans over a couple of months, and then all of a sudden, one of the borrowers calls us and says, we're having some cash flow problems, we're having some working capital problems, we're not going to be able to make the full next payment. How about if we just make the interest payment on the loan during this next period? All right, so now think about this, risk data aggregation. So we have, 100 of these loans. So we put them, think of an Excel spreadsheet, and we can find commonalities and unique characteristics of each of these loans. So we can look at that one particular loan that is going to only make the interest payment next month, and we can find other borrowers out there who meet those kinds of criteria so that we can plan for more financial stress on the asset portion of the balance sheet. Principle 2, data architecture and infrastructure. So data architecture is a model, maybe it's a policy for how a financial institution collects the data, how it stores the data, how it manages the data, how it sorts the data, who has access to the data, and then what kind of reports are likely to be produced by the data. So once again, think of that example of commercial lending. We have 100, right? So think of an Excel spreadsheet where we have 100 columns and we might have 10 variables in there. And what we're trying to do is make sure that the architecture, the development of that Excel spreadsheet is consistent with the normal reporting practices of all of the functions of the financial institution, especially during times of financial stress. All right, so what do I have in my circle points there? Make risk data aggregation and reporting a key part of the planning process. That makes perfect sense. Establish integrated data classifications and architecture. So think about, we've got these silos, and remember, they're not individual silos. We kind of squish them together so that we can see their correlations, but we have data classifications, commonalities, and differences between, let's say, our residential mortgage lending arm and now our commercial lending arm and anything else that we have as that part of the balance sheet. Look at my last checkpoint there. We need to ensure that the data is relevant, entered correctly, and aligned with, the IT specialists have all of these principles and taxonomies and protocols that are going to be part of, their language and their kind of, home base, so to speak. And we need to make sure we need to make sure that the data architecture is consistent with what they're doing, and then it's consistent with what we're doing and what we need as financial risk managers. Now, here's a really fascinating point. We need to have a robust IT system, this infrastructure, so that we can make decisions that are consistent with the goal of the business. Remember this from your corporate finance days. The goal of the business is always to maximize the wealth of the owners, which is probably the shareholders in publicly held corporations. And part of that goal is to do this over the long term. Over the long term. Now, the problem is that this infrastructure can be quite expensive. And so you got to do this, marginal cost versus marginal benefits. The problem is that marginal costs can be substantial, and those are incurred today. The marginal benefits are incurred over time, maybe 5 years, maybe 10 years. So you have to take the present value of those marginal benefits. But the committee believes very strongly, and I of course agree with this, that the benefits outweigh the costs. So in the corporate finance language, this means that this IT system has a positive net present value. Principle 3, accuracy and integrity. What we need to make certain is that the data aggregation and reporting should be reliable, and there should be a system of controls that is robust to ensure that accuracy and integrity, and then there should have some kind of a source of authority to make certain that each type of risk has its own system of controls and its own way of ensuring accuracy and integrity. Each type of risk, remember, for a financial institution, there's credit risk, there's market risk, there's operational risk, there's moral hazard. I mean, that's a fascinating thing. Making decisions knowing that there's going to be a bailout sometime in the future means that you'll probably make more risky decisions. But what if you don't get bailed out? Oh my gosh, then what happens? So you got the moral hazard, you have liquidity risks. Don't forget about business risks and reputational risks and contagion risks. And so you've got all of these types of risk, and we need to make certain that the reporting of the risk data is accurate. Let me give you just a quick example here before I move on to the next slide. I was at the food store the other day, and I bought a little over a pound of haddock, and the guy packed it up and I checked out. And when I got home, I looked at the bill and I was charged $26 for a pound of haddock. And as I cooked it for my family and we ate it, it was really, really good. And I made the comment, I said, you know what, this is really good fish, but it's not worth $26. So I had to go back to the store, and of course it was entered manually and it was entered in correctly, and I got some of my money back. But my point is that accuracy and the integrity of the data is critical, right? You don't want to be a financial institution and charging people $26 for a pound of fish. All right, so continuing on with this principle, risk management personnel should have access to the risk data. Of course, that makes perfect sense. There has to be a balance between the automated and manual systems, going back to my fish example. There also has to be a policy to be able to correct any inaccuracies or any inconsistencies or inefficiencies. In addition, there has to be a process where these manual processes and desktop applications have to have effective controls. So go back to my Excel spreadsheet. It's just as easy for me to enter $26 for a pound of fish as it is to put in the correct $8.99 that I should have paid. So there has to be a process under which you can't have people inputting data for 100 straight hours because they're going to make mistakes. Now remember, we have these silos, and so the data should be consistent across all of those silos so that we're not entering a 0 for something over here in this silo and a 1 over here for this silo, and those would compete against each other. And then there has to be reconciliation. So there has to be an individual or group of individuals who kind of take a step back and say, all right, here's all of this risk data. Does it make sense does it make sense from a bank-wide perspective, both from an accounting perspective and a risk perspective, and so those data should be reconciled. Principle 4, completeness. Now, I teach my students all the time that in my classes, what we're going to do is we're going to do this. We're going to talk about breadth. All right, so the data aggregation ought to have enough breadth. Remember all those risks I just talked about, liquidity risk and market risk and moral hazard and operational risk. So we have complete. We want to make sure that we have complete data on all of those individual types of risks. And then we want to go this way. We want to go deep. So we want breadth and we want depth. So principle 4, look at some of my circle points here. It requires that on the balance sheet and off the balance sheet risks should be aggregated. So if a financial institution is using a special purpose vehicle to do some stuff, kind of like the Enron days, and lots of financial institutions do this as well. So that data should be aggregated. It should always be complete. And notice my last circle point there. It's not necessary to express all forms of risks in a common metric or basis. And so that means that, for market risk, we might look at beta. For operational risk, we might look at standard deviation between, revenues and expenses. However, what each different silo, each different bank group is probably going to have its own unique metrics or measures, but that system can still be aggregated so that there are acceptable levels of beta, there are acceptable levels of standard deviation, and that of course is determined by the corporate leaders or the board of directors who determines the risk appetite. Timeliness, I'm not sure that these principles are given in the order of their importance, but if they were, I would think timeliness ought to be somewhere nearer to the top than 5th, because remember, what's the goal here of this committee? To promote financial stability. What that means is that when you need help, you got to have it. Right? So go back to the 2007 and 2009 financial crisis. I mean, in retrospect, it was relatively easy to predict that the housing market was going to have its bubble burst, and that was going to have implications throughout the financial system. But the timing of it was probably way more difficult to predict. And so this principle 5 of timeliness has everything to do with being able to generate a report immediately so that we can handle a financial crisis. So notice that bullet point there, rapidly during times of stress or crisis. Critical risks include things like trading exposures or operational risk indicators or aggregate credit exposures. But, my favorite is the credit exposure in derivative contracts. Go back to my, one of my favorite movies of all times. I'm hoping you guys have seen Trading Places. So what happens at the end of that movie? Duke and Duke Securities, they thought they were trading on some private information, but they were fooled and they were betting in the opposite direction. So they were trying to corner the market in orange juice futures contracts. But Eddie Murphy and Dan Aykroyd were very smart and very funny. And so they released the actual crop report, and it showed that there were going to be millions and millions of oranges. So the price fell. And Eddie Murphy and Dan Aykroyd then, they shorted the contract, so they benefited when the price went down. But then Duke and Duke, they were so upset. They said, turn these machines back on. I mean, these individuals, they were totally stressed out. They needed a report right there to help them. Of course, I don't think this committee is really worried about Hollywood movies, but here's the point. The point is that Duke and Duke Securities, these two guys, they needed a timely report so that they could manage their problems. That was an individual company, but then let's spread this out to the entire system. How about principle 6, adaptability? Banks should be able to generate aggregate risk data to meet a broad range of on-demand ad hoc risk management reporting requests. So going back to my going back to my commercial lending example, what did I say? We have about 100 of these loans out. And so at the margin, let's suppose we wake up and come to work today. At the margin, we're going to say, we're going to lend, maybe one or two. And maybe these one or two have interesting scenarios. Maybe they have bad credit. Maybe they have instability in their operating or free cash flows. Maybe they just have a turnover in management. So we need to adapt these reports that says something like, all right, give me an assessment of the credit risk of this potential borrower based on these particular needs. So notice my circle points there. Assess emerging risks, incorporate changes in the regulatory framework. I haven't talked about this at all. I mean, this is so important. We have these political leaders in Washington and in other countries who sit around and they think, how can I make some laws? Because remember, that's their job. How can I improve the efficiency of regulations? Sometimes they improve it, sometimes they don't improve it. But the important part is that the politicians are going to change laws and change regulations. So as good financial institutions, we need to be ready for those. Principle 7, accuracy. You might remember that one of those earlier principles was accuracy and integrity. That one was more focused on, kind of like the data itself. This principle here is kind of like the output. Risk management reports should be accurate and precise so that the senior management and the board can rely on those reports with confidence. So we have accuracy in the collection and the management of the data. And now this principle tells us that we need accuracy in the reports that are produced by that data. Comprehensiveness, of course, we need to make sure that we go like this. So we have these significant risk areas. I've talked about these: credit risk, market risk, etc. And we have some components of those risk areas. So these are the variables that I was talking about earlier, and they can relate to regulations or economic capital. But here's the important part, that last circle point at the bottom, that these emerging risk concentrations are forward-looking forecasts, and they're able to allow us to test under stressful environments. Principle 9, clarity and usefulness. So of course, what we want to do is make sure that the report is clear. When I give my graduate students an assignment, I typically call these a memo assignment, and I limit it to 3 pages. And I make the comment, I say to them, hey, when your boss comes to you and says, write me a memo on something, and here's the project, does your boss want to read 3 pages of memos? And the answer is no. Does your boss want to read 2 pages? And the answer is no. Does your boss want to read 1 page? Probably not even 1 page. So it needs to be clear, and it needs to be brief. And it needs to be useful. What the bosses want is they want to read something and say, this is what I need to be able to make this particular decision. So notice my second bullet point there, the right balance of qualitative and quantitative. Now, of course, in my academic setting, I extend it to 3 pages because, I just got to have 3 pages so I can grade them properly. Frequency, this is really an issue that comes up in almost all professions. I mean, how often do we collect data? How often do we produce reports? How often do we make decisions? And so what this principle 10, frequency, focuses on is a routine, and that whenever we need one, that's when we ought to be able to produce a report. But there should be established timeframes and regularity and guidelines. And so whatever it is, I mean, clearly we're not going to do this every day, but we ought to have the potential to do it every day in the event of a stressful time or crisis. So notice my last circle point there. Some exposure information may be needed intraday if we're trading derivative securities. So we might have to do it several times a day. We might only have to do it monthly. Depends, of course, what the output and the ultimate decision is. And then we need to make sure that the reports are distributed to the relevant individuals and groups of individuals, and we need to make sure that we ensure confidentiality with this timely dissemination. And then the final the final three principles are review. Supervisors should review. Remedial actions. We talked about this in a previous chapter, that when we make a financial decision, we need to then see how it plays out, and where did we go right, where did we go wrong. And then this last principle, cooperation between and among all of the different and relevant supervisors and important people. And that takes us through chapter 13. Next up are some codes of conduct.